From TGE, and in today's video I want to talk about how to size, how much to size on options as a six-figure investor. Okay, so if you have a six-figure portfolio and you do not know how to size into options yet, then this is gonna be the video for you. And if you don't watch this, do not trade options. Okay, it's going to blow up your account. So this is how you avoid doing that. All right. And so I wrote an article here, and I will show you guys some examples as well too here, so you guys are not flying blindly. So I said the number one reason six-figure investors fail as traders, or even in the option world, is not because of bad trades or bad timing. Okay, it's because of sizing. Sizing is the number one reason why all traders fail, or why anybody really blows up their account. Okay, I used to run a journaling platform, and traders that would go in there and log their trades, their number one problem was always oversizing. And this is what I mean. Okay, let's pull up a draw. Okay, look, I'm gonna show you guys. So this is what they would do. All right, they would go here. Let's draw here. We're gonna use this. They would go into a trade, one trade, right? And they would take the riskiest trades without knowing what to do. Let's say 25K. Okay, 25K, one position. They will lose 50%. Okay, this is really bad, especially when your account is only like 50K. And I've talked to investors who had $300,000 accounts, and they blew it down to like $2,000. It's really bad. So if you do not want to be in that category, watch this video. This is really, really important. Okay, it's always been and it always will be about survival in this game. Okay, so this is the total account value. They lose this trade and then they get scared. Okay, that's problem number one. They get scared because they lost. Well, problem number one is they oversized based on this account size. Number two, 50%. And then they go into the next trade with a $500 position size. And they win this one at like 100%. The problem here, and they feel good for the short term moment, but when they realize how much they're still like missing like $24,000 here, right? Like they lost 25K here, and they only made up $500 here. Like it does not equate. This is the number one reason. It is oversizing. Okay, and this is very relative to per. This is very relative per account size. Okay, for some account sizes, $50,000 is not a lot. For some account sizes, $25,000 is not a lot. It's a small portion. Now I'm going to break down how much you should be allocating in options. Okay, so you are not burning up your capital like I've seen in that journaling platform. All right. So not strategy, not entry points, not marketing use. It has nothing to do with that. It's always and has always been oversizing. Oversizing is the number one issue. Okay. So just remember that. That's the only thing you have control of. The market is very random, and we use tools to forecast future pricing, right? But but we still don't know what price is. We're just making educated guesses, right? Based on option premiums, based on the option flow, based on some other factors, right? But the thing that you do have control of is your risk management, your sizing, your position sizing. That's the key. When you have a six-figure account, it's easy to think that you have more room to play. But here's the truth. All it takes is one oversized trade to erase months, sometimes years of hard work. I had a student actually who had a $50,000 account. He took one trade of $1,000. He won. He got very, very comfortable. He thought he was like the shit, right? And then he took another trade at $25,000, and he made a lot more money. He won again, and then he doubled his position size again, and he lost it all in one single trade. It was gone. Okay, and there was 0-day expiration, and it just wiped it all out. So all it really takes is just one trade. So if there's anything you get from this video, you should always have at least the problem of undersizing. That should be at least the problem that you should have, not oversizing, okay? Undersize. Let me give you an example. Imagine you're playing poker at a high stakes table, right? You've built up your chips over several rounds playing smart. Then you get on a hunch, you go all in one hand, thinking that this looks good, and then you lose. It doesn't matter how smart you played before, right? You're back to zero. So everything that you work for, yeah, that's the past. You did good, but now it's like it doesn't even matter because you lost everything. That's what oversizing does. It's not just a bad trade, it's a bad habit that kills your ability to stay in the game. And that's the whole thing about this, about trading. It's survival. I always tell all my TGE Max members, your number one, these are your rules, your two rules, your objectives, right? Uh, maximize your gains, and number two is maximize your gains while protect. I'm sorry. First, protect your capital. That's number one. All right. And then number two is maximize your gains while protecting your capital. When you have X amount of a capital, you got to protect it. How much can you go in that's appropriate? And then let's say you go in with $1,000, and then hits $2,000. That trade goes to $2,000. You're no longer risking $1,000. Now you have in paper $2,000. So you have to manage that risk. Okay, so you're always protecting your capital. You're always risk management. If you're an active investor, if you're doing options, whatever the case is, you always have to be active on managing your risk. Unless you're handing it over to some firm or just putting the S&P 500, if you're active on it, you always have to manage, no matter what. That's just something that, and maybe that's something that people don't talk a lot about when you're like doing this actively. It's one of those like nobody talks about it. It's quiet, and you don't even know it, but you're doing it. You have to. Okay. Okay. So capital allocation, max risk zones. Okay, so this is what I teach my students, right? I say like, how much can you put in options? So how do you stay in the game, right? You need rules, you need a system, and you need guardrails that protect you from yourself. That's where capital allocation comes in. This chart below breaks down the maximum account exposure you should allow based on volatility. So we like to look at the VIX. It's really simple. We don't like to overcomplicate it too much. And we look at different VIX levels. And we'll say, this is how much we're allowed to allocate on how much of our capital we're allowed to allocate based on the VIX level. So let me pull up the VIX itself. Okay, this is the VIX. You could get this image here in the article, which I'll put a link in the description box. But this is what it looks like. Okay, let me put my face in there. All right. So between up to like 15, we'll allocate about 25% of our max allocation of our capital. So let's say you have a $250,000 account, or let's keep it simple, 100,000. I'll allocate at the most 25%. If we hit these levels that we're currently at, and between 15 to 20, we'll do a max allocation of 30%. From 20 to 30, it will be 35%. From 30 to 40, 40%. From 40 to 50 and probably higher, it's just 50% of max allocation. Okay? And the reason we like to do this is because the risk doesn't change. It's the same. Okay? But what changes is the delta. How much the dollar on the security can move because there's so much volatility. So you can make more money. Okay? The risk stays the same. Okay? In the sense of like your strategy will be like if it's a 60% win rate, it's a 60% win rate, right? Whatever that case is, it doesn't increase your chances of winning more, but it does increase the chances of making more money because there's more movement in the dollar for that security. Okay, because implied volatility is really high. So that means that when it goes as VIX goes up, you can allocate you have to manage your risk. You can add more capital. It doesn't mean that you have to, okay? But don't be afraid of volatility as well too. We're here to make money, okay? But while protecting our capital. And as the VIX levels come down, you have to start de-risking. You have to start cutting positions off and lowering how much you're allocating to the market. And so this is how we have to actively manage our risk throughout the year inside TGE Max. At least this is how we do it. All right. So there's these levels. You could go look at these in the link below or something if you want. These aren't random numbers, they're based on probability and market conditions. When the volatility is low, you stay light. When it spikes, there's more edge, as in like there's more dollar movement, but also more danger. So remember, because there's just sharp reversals, everything is it gets more unpredictable. So does this mean that like you put 35% or 40% on one position? Absolutely not. Okay. That's just how much you're able to allocate to the market. At least this is our guideline. And then as but like when we're starting to size in to a position, we like to keep our position size small based on our net lick or net liquid, right? Not how much buying power we have, how much our total account value is. Okay. The biggest thing in this market is it's all probability, it's all math. So all you have to do is give yourself enough chances to be right. Okay. So let's say here is an example, right? This is the power of small position sizes. So let's say that you have a $250,000 account, total value, and if the VIX is sitting around 21, you should allocate about 35%, right? So that means that you can deploy up to $87,500, but it doesn't go all in one trade, right? It spreads across. Give yourself enough chances, enough occurrences. And so here's a breakdown how we like to do it inside TG Max. It depends on the days to expiration. If there is less than 45 days to the expiration, we'll do about 0.5 to 1% of our total net liquid. So that would be about $1,250 to $2,500 per position size. Okay, so you see, like if you have a 250K account and you lose 2,500 bucks, yeah, it's it could be a lot of money to depending on the person, but overall, you're not blowing up your account. You can still take more trades. You have a lot of liquid in your account, a lot of capital. If you do 45 days or more, this is what we call midterm. We will allocate about 1 to 3% of our total net liquid, which in the $250,000 account, that may be about $2,500 to $7,500. Okay, and we also like to trade leap options, and so leap options, not a lot of people know about them actually. They're contracts that are a year plus out. So today we are in May 12th. We're not talking about January 2026. We're talking about getting May contracts of 2026. That's a year out, 365 days out. So, and we can allocate up to 3 to 5% because we're so far out. It's less volatile. And so, in the $250,000 account example, that's about $7,500 and up to $12,500. Okay. This is how we like to size into our trades based on days to expiration, based on how much what the VIX level is, right? How much we're able to allocate to the to the market. And so this lets us take multiple calculated shots instead of swinging hard once and hoping it hits, right? So it's all about staying small. It's all about taking as many chances as possible to give you the probability of becoming profitable for the end of the year. Okay? So why does small positions work? This is the part most investors miss, and even traders. Traders definitely miss it. You don't need big trades. You need a lot of smart ones. Okay. Each small trade is like a single bet with edge. You're stacking your probabilities in your favor over time to maximize the upside, protect the downside. Okay. By staying small, you maximize the upside, you protect the downside, and it gives you more chances to catch something big. Sometimes in the market, we're taking a lot of small, we size in small inside TGE Max, and every now and then, our account value is like sideways, and then we catch something big and boom, it pops it over, right? And those are good days. And then when it pops over and we have that new capital in our account, we protect that, okay? And then the same thing, okay? Sometimes it goes down slowly too, and then it pops up, right? And so by staying small, it keeps you in the game longer. So that's how pros think. That's how institutions think. They don't bet the farm. They manage exposure. Okay. And so in this article, I talk about now that you know how to size in, now you just need a strategy. And so how Gextron can help you figure out the expected move, like knowing the boundary ranges, knowing where support and resistance are, um, and so on. Right. Okay. And so that's the, if we just go down to the bottom of this, we say the bottom line is if you got real money in the market, you cannot afford to trade like a beginner. Do not do it. I already seen it. I hear about it all the time when people are joining the free community and I'm talking to people on Zoom. They're like, I had $300,000 and I blew it all. That sucks. That sucks. For us, blowing up your losing more than 10% of your portfolio at six-figure range, that's painful. Okay, that's really painful. So don't get to that point. Okay, so you need to know how much capital to allocate, right? So now you know based on volatility, how much to risk per trade, which now you know. And if you need to like reference this again, just go to the link in the description. I'll put the article in there, the article link in there. When institutions are stepping in, right? You just want to know like you like tools like Gagstron. They help you know like where's the bottom support at the moment and where's the maximum resistance at. Okay, and when to pull back, like quarterly expected earnings, quarterly expected ranges. Everything's about quarterly cycles. Okay, so this isn't about trading anymore. It's about trading smarter. And your capital is your fuel. Oversize and you burn it all. Size right and you buy yourself opportunity. And Gextron gives you that data and discipline. Okay, that's pretty much it. How much in the video is there? 16 minutes. All right, so that's pretty much it. If this was helpful, or if you want to try out Gextron, or you want to trade with TG Max and just learn how to trade options and any of that, I will put a link in the description. I'll put a bunch of links in the description box. Feel free to click around. Gextron is 7-day free trial, so it's risk free. You lose nothing by trying it out, and you get to be inside a Telegram channel for 7 days. And if you have any questions, just put them in the comments down below, and I will get back to you. All right, peace out.